My name is Pat O'Connor, and this is video number 17 in my National Mortgage Exam tutorial series. Today we're going to talk about loan products, but before we start, I want to mention that the information in this video series is taken from my study guide that I have published on Amazon in both Kindle and paperback formats. I personally think paperback is better for studying quizzes and practice exams, but that's up to you. There are hundreds of questions and answers, as well as an excellent overview of the business in general. Second thing is that subscribers may request a download link to a quiz, and the instructions on how to do that are at the end of the video. So you need to stay tuned if you want to be able to get a copy of the quiz. All right, let's start. The first loan product that we're going to talk about is a reverse mortgage. This is a product in which elderly homeowners can take advantage of the equity that they have in their home. The most popular form of a reverse mortgage is called a home equity conversion mortgage, or a HECM, and it is FHA's product. So if it's FHA, there's going to be fees. But it is the most popular one because lenders like it, because it's 100% insured that they won't lose money if the payout is more than the value of the home. So there's no maximum payout. So a lot of people are living now to be 100 years and older. The youngest borrower has to be at least 62 years old to qualify. So as long as they live in the house, if they choose, they can receive monthly payments. So somebody who's getting monthly payments for 40 years may well, when they die, their payments may exceed the value of the home, and that's okay. The government, HUD, will reimburse the FHA lender for any losses, and that's why it's the most popular product, because the lenders like it, because they know they're not going to lose money. Requirements: youngest borrower must be 62 or older. The house is a one-unit primary residence, and this includes a condominium. No existing mortgage on the property, or one that can be paid off with the first reverse mortgage payment. The borrower must receive counseling from a HUD-approved home counseling agency. It's going to tell them about the pluses and the minuses, pros and cons, and talk about a few of those in a minute. The borrower must maintain their hazard insurance, pay the property tax, and pay any monthly fees that the lender may require. And this is where borrowers, the reverse mortgage people, may get into trouble, because once they have their loan paid off, a lot of people decide to roll the dice and no longer have hazard insurance. And hazard insurance in some states can be quite expensive. Here in Florida, it seems to keep going up and up, and our hazard insurance companies, every week there seems to be a notice that they're pulling out, because as prices go up in the homes, then that insurance, if it's going to be a complete replacement, it's going to cost the insurer, more and more money. So premiums keep going up, and that's even without us being hit by a recent hurricane. So if you have a reverse mortgage, now you have a lender. And the lender is going to require homeowner insurance. And this may be something that the HUD counselor will warn them about, right? You're going to, yes, you'll get money, but you're also going to have to pay this hazard insurance on your property. So, look at your budget. Can you afford it? Payments can continue for as long as the borrower lives or the property is vacant for more than 12 months with a healthcare issue. Maybe they're in rehab, right? And it's a long-term rehab. This is another drawback of the loan. Property is vacant. Nobody's in there because they're in rehab. FHA can call the loan due. So that's one of the cons. You will need the borrower will need a new FHA appraisal because how much money the borrower can get depends on their age, interest rate at the time, and the value of the home. What is the current value? And so then what's, how much equity? And they may give 60% of the equity as, to do their calculations on what monthly payouts may be. And that number may change. In this case, the older you are, the better. The minimum age is 62. And that is, throughout the mortgage world, 62 is like the age HECM has for elderly discrimination. It's 62. Reverse mortgage says these are the elderly homeowners. And so that's the time that they can start. If they wait longer and everything else is equal, they will qualify for more money because the amount of money that they can get goes by life expectancy charts. Same as life insurance may do. How much longer do they expect you to live? So here, if you're 62, the expectation in the U.S. for a woman's probably now like 85. Lots of people are living to 100, right? Plan on being one of them. So if you're 75 when you apply, you'll most likely get more, money approved than the 62-year-old. Also, since you guys are going to be loan originators, and gals are going to be loan originators, sometimes you may counsel them that maybe there's a 62-year-old woman married to a 72-year-old man, or vice versa. They may only put the older homeowner on the loan. And so then they would qualify for money, for more money. But it can also run into problems if the older borrower dies and the younger one's not on the mortgage. What will happen? And I think recently the FHA has become less harsh than they originally were on what would happen to that loan. All right, these are called non-recourse loans. Now, residential loan originators may not be familiar with that term. A lot of commercial property loans are non-recourse. What this means is that there is a mortgage lien on the property, right? If the individual can't make the payments, they miss their payments, they don't pay property taxes, they don't pay hazard insurance, like any one of those three things, the lender can foreclose. And if you have your own home and you foreclose, Some states will allow the lender to sue the property owner for any differences between the sale price and the note amount. All right, and those are called recourse loans, that the borrower is liable for the difference between the value of the collateral and the value of the note. Okay, so reverse mortgages are non-recourse. If a borrower dies in the property and their heirs inherit it, and the heirs want to sell it, FHA has to accept an arm's length fair market transaction sales proceeds as the payoff for the reverse mortgage. The heirs cannot be held responsible for making up that difference between the value of the collateral and, in this case, the amount of money that's been distributed. And that's non-recourse. Home equity line of credit. That's the next loan product I'm going to talk about. It's called a Heloc, home equity line of credit. And this is also, again, based on the equity that they have in the home. And this would be a new appraisal. All right, maybe they've lived in the home for 5 years and property values have gone up or down. So it's where they can draw money. So the amount of the available credit line usually depends on the borrower's equity in the home. Equity means the new appraisal value minus the loan balance, and that's the equity. And they can get approved for a certain percentage of that equity. And they withdraw the funds for a stated period of time. Maybe it's a 10-year HELOC. So that means they can draw for 10 years. And then they would pay like the interest on it, the way that you do with a credit card for that 10-year period. And then after the 10-year, they have a repayment period. That may be 20 years, where they start paying like it's a mortgage, where they pay the loan balance down. Okay? So the problem with this, and it happened during the recession that started in 2007, unlike a purchase mortgage, lenders can call this loan due. They can cancel the loan at any time. There's no stipulation in the HELOC documents that they have to have a reason for calling the loan due, like missing payments or, not paying property taxes or hazard insurance. You don't have that. They can call the loan due. And they did it because I think home values were falling, right? You had the recession, values were falling, and then they had this semi-commitment to borrowers to keep loaning on equity that may have disappeared in the house. So they were called due. So that's one of the big drawbacks of a HELOC. Construction mortgages. These are usually short-term, like a year or less, temporary loans in which money is advanced through the stages. As a general contractor needs the money, they draw it. There may or may not be a lender or inspector involved to oversee the construction loan work. And the borrower pays the interest on each draw. It's like, okay, the contractor now needs $100,000 or, to do framing, plus windows, plus, whatever. And then 3 months later, all right, You know, we're putting in floors, we're putting in cabinets, blah, blah, blah. We need extra money. Okay. Because there's no structure here to be collateral, unless they own the land that the building's going to be put on, you know, that may be a different story. But there's no collateral here. So there's nothing, if you stop missing payments, that the lender can seize. They'll have a half-completed structure to claim. But, you know, what's the resale value of that? So interest rates can be higher on construction mortgages. They can have stricter qualifications for a borrower than some other types of loan might have. All right, so the last type of loan product we'll talk about are interest-only mortgages. You might not see a lot of these around now because they're not qualified mortgages, so Fannie Mae not buy them. So the interest rates will be higher on these loans because lenders have to find, unless they want to keep it in their own loan portfolio, lenders need to find another entity that will purchase this loan. But the borrowers pay only the monthly interest due during the specified term of the loan. And then the borrowers have 4 choices. They can make a lump sum payoff, like a balloon mortgage. They can refinance that into a fixed rate or an ARM that's amortized, so it'll spread the payments out over, 15, 20, 30 years. They can start paying off the balance that's due at a higher interest rate than what the interest-only rate was, probably, unless interest rates have taken a deep dip. You never know what's going to happen. So that's it. We have talked about reverse mortgages, we've talked about Helocs, construction mortgages, and interest-only mortgages. Next week, I'll discuss some terminology. I am following the guideline that the NMLS publishes. There is a link to it in the description of this video for the state exam. The instructions on how to get your link for subscribers to download a quiz on this particular video should be above my head now. If you wait a second, then there will be links to a couple of the other videos in this tutorial series. All right, thank you. I will see you next Wednesday. Bye.